We're still looking at a Form 1040, which is the US individual income tax return. So we looked at the form, we looked at all these schedules, schedule 1, 2, 3, 4, 5, 6, and then we had schedules A, B, C, D, E, F. Now the question is, who must file Form 1040? And the requirement here is that all individuals who have income levels which is in excess of the standard deduction dollars need to file. Think about it. Any individual who's got income less than the standard deduction dollar, let's say income is less than standard deduction, for that individual taxable income would be zero. So Uncle Sam says it's okay if you don't file. But if your income level is above standard deduction dollars, then you have to file. Or let's say if you're an individual and you're running your own shop, you have self-employment income, business income on Schedule C. In that case, you are required to file the moment that Schedule C business income is $400 or more. And the reason is, on the self-employment income, besides income tax, there's also self-employment tax. So just in case, for the self-employed individual, even if taxes are zero, they'll still have some self-employment tax payable, and that's where the threshold for self-employment income is as low as $400. Now, if you are an individual who's filing 1040 and has some refundable tax credit, and let's say your refundable tax credit is in excess of your tax liability, then you better file your Form 1040 so that you get a check back from Uncle Sam. Let's get to Reg 1, page 12, where our question at hand is who must file Form 1040? And the first one, highlight individuals with income greater than the standard deduction amount. Now, there are other situations where even if the individual's income is not greater than the standard deduction, the individual needs to file Form 1040 if highlight net self-employment income is $400 or more. And this requirement is there because, right, as self-employment tax will be payable on that self-employment income. So, though the individual may not have any federal income tax due, but the individual will still have self-employment tax payable. Hence the need to file the Form 1040. The last sub-bullet on this page. Even if an individual does not otherwise have to file a return, the individual should file the return to get highlight a refund of any federal income tax withheld. Also should file if the individual is eligible for any of the highlight refundable credits. So basically here the purpose of filing 1040 is, right, to claim dollars back from the IRS. So to get a check back from Uncle Sam. The next question is by when to file Form 1040 with Uncle Sam. And the requirement is that given most individual taxpayers are calendar year taxpayers, they need to file Form 1040 by 15th April of next year. Now, individuals of course have this option of taking a 6-month extension where filing date can be extended from 15th April to as far as 15th October. However, this extension is only for filing of the tax return. The payment of taxes, That needs to happen by 15th April. On page 13, the question at hand is when to file Form 1040. And the rule is 1040s need to be filed by 15th April with provision to obtain a 6-month extension up to 15th October. So right there, by 4/15, that's 15th of April plus 6 months. Now, underline this 6-month extension is granted automatically to the taxpayers when they file Form 4868. Now, this 6-month extension does not extend the time to pay, only the time to file. So, in the next bullet, highlight pay tax by 15th April. Extension is for filing only, not for the tax payment. And there are underlined late filing or no filing penalties of 5% per month of the tax liability. And underlined late payment penalties of 0.5% per month of the net tax liability. Now, in case of late filing as well as late payment, the total is limited to 5% per month. And the maximum for both the penalties is 25% of the net tax liability. We also have highlight Form 1040X, which is for underline amended returns. Circle or underline claim of refunds. Now, Form 1040X highlight may be filed up to the later of highlight 3 years after original due date, including extensions if extensions have been used in filing of the tax return, or highlight 2 years after actual tax payment. So later of any of these two dates. On the last bullet there, we have highlight IRS's statute of limitations. So that's the time period that IRS can come after the individual for taxes due. If there is highlight an error or simple negligence by the taxpayer, IRS has highlight 3 years to come back. If there is highlight gross negligence, IRS gets 6 years. But if there is highlight a fraud or failure to file, the IRS has highlight unlimited time to come after the individual for their taxes due. Let's now talk about filing status on your Form 1040. Let's say you're happy and enjoying life to the fullest. We know that on your 1040 you may be single. But let's say you're married. In that case, on your 1040, you're going to be either married filing joint or married filing separate. So basically, if you're married, you're going to have two options, limited options on your 1040. Either married filing joint or married filing separate. So when we say married filing joint, the husband and the wife, they come together. It's one return, one 1040 for both of them. But if we talk about married filing separate, it's one 1040 for the husband and another 1040 for the wife. Now, most married couples want to go for the married filing joint status as it's more tax efficient. Think about it. Let's say we are looking at a husband and a wife with different levels of income. The husband's working, he's getting a lot of salary income. The wife, let's say, is a homemaker, raising the kids, she's got less income. Now, if these guys, they do married filing separate, the husband would end up paying a lot of taxes to Uncle Sam. But if they decide to come together and do a married filing joint on their 1040, the tax liability for the married couple, which is now one entity, may significantly reduce. So basically, let's say we're talking about a married couple with differences, let's say they have a lot of fights around the year. At the end of the year, Uncle Sam tries to bring them closer, tries to bring them together because they're going to be married filing joint on their tax return. But let's say if we're talking about a married couple where nothing can bring you together, not even taxes, then the couple could do married filing separate. Now, we are talking about marital status as of 31st December, as of the end of the year. So, even if you get married at New Year's Eve, on your 1040, you either will be a married filing joint or a married filing separate. But let's say at the end of the year, you're legally separated or divorced, then you're back to single again, happy and single. Now, for single taxpayers who have dependents on them, who are supporting others, they could upgrade their status from a single to, let's say, a head of household. So what we're saying is a head of household is also a single who's, let's say, having a dependent child. So let's say a single mother could be a head of household because she's single and she's having a dependent child who lives with her at least for half the year. Or let's say a single guy who's having a dependent parent who's supporting his dependent father. Even he could be a head of household. Or if you're supporting your uncle, your aunt, your nephew, your niece, a dependent relative, even that could make you a head of household, provided you provide for over 50% of the cost of the household. Because we are talking about the single individual being a head of household, providing for over 50% of cost. When we talk about dependent child, the dependent child needs to live in at least for half a year in the household. Dependent relative, again, the requirement is at least half a year living in the household. But when we talk about dependent parents, they're not required to live in. So let's say even if the parent or the parents live in a retirement home, that's fine. So generally what we see for head of household is half year requirement if it's a dependent child or a dependent relative. And look at this, playing with the letter H. So we say head of household. So you're saying half year, again we're saying half year out here. So guys, so we're looking at single parent with a dependent child, upgrade from a single to a head of household, or responsible citizens taking care of their parents could upgrade from a single to head of household. Now, the reason I'm saying it's an upgrade is because a head of household has better tax slabs vis-a-vis a single filing status. Also, let's say a head of household gets a higher standard deduction vis-a-vis single. So that's why I'm saying it's an upgrade. It's better than single. Now let's talk about a scenario where somebody's spouse has died. So that makes him or her a widow or a widower. In that case, there could be a qualified widower status kicking in. So when we're talking about a widow or widower, we are still talking about a single. So we're talking about a single whose husband or wife, whose spouse has died in the last 2 years. So let's say in the year of spouse's death, you're still a married filing joint. You could still be a married filing joint. So basically, let's say if somebody's spouse has died during the year, Uncle Sam still allows the filing status to be a married filing joint as if the spouse is still alive. And up to 2 years after death, provided the individual does not remarry. If the individual remarries, again a married filing joint or a married filing separate. But if the individual does not remarry, up to 2 years after death, plus up to 2 years after spouse's death, the individual could be a qualifying widower, provided the individual has a dependent child living in with the individual for the whole year. The dependent child here could be own child, it could be a stepchild or an adopted child, again living in for the whole year, and the taxpayer is paying for over 50% of the cost of the home. Now when we said head of household, we said we are okay with half year because head of household was all about H. Qualifying widower is all about the W, and that's why we're saying whole year out here. So once again, if you're married, I said you're going to have limited options. You could be a married filing joint, one return for the husband and the wife, or a married filing separate. But if you're a single, you actually have more than 2 options. You could be a single, you could be a head of household, or you could be a qualifying widower. Now, when we look at all these status for single taxpayers, single is like the plain vanilla base status. Head of household, as I told you, is like an upgrade for tax purposes, better tax slabs, higher standard deduction. A qualifying widower is actually a further upgrade, where a qualifying widower tax slab is even better than a head of household. A qualifying widower standard deduction is higher than that for a head of household. Generally, the qualifying widower tax slabs and standard deduction are as much as a married filing joint. So it's like even though the spouse is dead, Uncle Sam allows the taxpayer 2 years to forget the ex-spouse. For 2 years, the taxpayer gets the same tax slabs as if his or her spouse is still alive. For 2 years, Uncle Sam allows standard deduction, again as if the spouse is still right there. So married, 2 options: married filing joint, married filing separate. Not married, single, plain vanilla, an upgrade, head of household, further upgrade, again conditions attached, up to 2 years after spouse's death, dependent child, whole year, could be a qualifying widower. On page 14, we're looking at filing status. The first bullet, highlight single. Next one, highlight married filing separately. And then we've got highlight married filing jointly. Draw a bracket for all these 3 and write status as of December 31st. So we're looking at the individual's marital status at year end. Next, highlight qualifying widow or widower, where the taxpayer is a widow or widower and enjoys the same tax slab and the same standard deduction as married filing joint. Now, couple of rules here. The first one, underline up to 2 years after death of spouse. And the second requirement, put a box around dependent child who's living in with the taxpayer for underline whole year, and the taxpayer is providing for underline over 50% of the cost of maintaining the household. Now make a little note at the bottom of the page. Right, if spouse dies, year 1 equals MFJ. So it's married filing joint status in the year of spouse's death. Next, right, year 2 to 3, right, may be qualified widow or widower. So the taxpayer can use the qualified widow or widower status up to 2 years after death of spouse, provided the taxpayer has a dependent child living in for the whole year. Right, thereafter, the taxpayer, right, may be head of household. Provided the taxpayer has not remarried and meets the requirement for being a head of household. Move to page 15 and highlight head of household. So this is, right, a single taxpayer with dependents. The dependent could be, put a box around a dependent child who's required to live with the taxpayer for over underline half year, and the taxpayer must provide for underline over 50% of the cost of maintaining the household. Right there, for example, a divorced parent who's single and having a dependent child living in. For a head of household, the dependent could also be, put a box around a dependent parent. Now, for parents, they are not required to live in with the taxpayer, right? Retirement home is okay. However, the taxpayer must provide for underline over 50% of parents' support or upkeep costs. The dependent for a head of household may also be, put a box around a dependent relative, which could be a sibling, grandparent, uncle or aunt, nephew or niece, step relatives, in-laws, but right, not cousins or freeloading friends. So let's say a guy is living in with his girlfriend for the entire year, and the guy is paying for all the upkeep costs, all the costs of the household. Even then, the girlfriend cannot upgrade the guy to a head of household status because she's not a relative. And we've been clear that cousins or freeloading friends do not upgrade a single taxpayer status to a head of household. Now, even for dependent relatives, they are required to live in with the taxpayer for underline over half year, and the taxpayer must provide for underline over 50% of cost of maintaining the household. Now, towards the bottom of the page, we've got a lovely table which differentiates between the requirements for the qualifying widow or widower status versus the head of household status. Put a star there. So a qualifying widow or widower status comes in with a dependent child who's a child or a stepchild. However, a head of household status could come in with a dependent child, could also be a sibling, a dependent parent, or a dependent relative. Now, for qualifying widower status, the dependent child must live in with the taxpayer for the whole year. For head of household, it's only a half-year requirement for a dependent child or a dependent relative. And for parents, even that's not required. They could live in a retirement home. We've spoken about dependent child or dependent relative, which let's say could help a single taxpayer upgrade status to a head of household. Or in case of widows or widowers, could help them upgrade from a single to a qualifying widow or widower. Now, for a child to be a dependent child, the child has to be a qualifying child. For a relative to be a dependent relative, the relative has to be a qualifying relative. So let's get on the other side of my board and talk about qualifying child and qualifying relative, which could be dependents helping the single taxpayers upgrade status. So let's talk about this. So we're talking about a qualifying child or a qualifying relative. Now, we'll talk about a lot of requirements for a child to be a qualifying child or for a relative to be a qualifying relative. Let's say there's a jar, and only when the qualifying child or rather the child fits into the jar, the child is a qualifying child. Only when the relative again fits into the jar, the relative is a qualifying relative. And this is the jar which is owned, which is created by the IRS, the Internal Revenue Service. So our mnemonic to classify a child as a qualifying child or for a relative to be a qualifying relative is going to be IRS jar. So we're going to do an IRS jar test to test whether a child fits into the jar to be a qualifying child. We will do an IRS jar test to check whether the relative fits into the jar to be a qualifying relative. So let me put that up here. So we got IRS jar test for qualifying child as well as qualifying relative. The I of IRS jar is the income test. Now, the income test does not apply for a qualifying child, but would apply for a qualifying relative, where the qualifying relative would need to have income only up to certain dollar thresholds. So think about it, guys. So what we are saying here is for a relative to be a qualifying relative, for a relative to be a dependent, the relative cannot be a rich person, cannot be somebody who's having a lot of income and still is a dependent. And that is where this criteria, where we're saying a relative only with very little income can be a dependent. Though there's no income test for a child. A child can have a lot of money and still be a dependent. But for a relative, it needs to be low income or no income. Moving on. So the R of IRS jar test is related test. We're talking about relatives here. So qualifying child, of course, needs to be a relative. So when we say relative, it could be your own child, stepchild, adopted child. Could also be a grandchild. Could be a sibling who's a child. And the relative needs to live in with the taxpayer for at least half year. So there are two requirements, relative and half year for a qualifying child. For a qualifying relative, of course, The relative needs to be a relative, but there's an or here. So it says the qualifying relative either is a relative or living in for the whole year. So what we have here, what this means here is that let's say if you have a friend or a cousin who's not a relative, even that cousin or friend could be a qualifying relative if that cousin or friend is living in with the taxpayer for the whole year. We'll get to that in a moment, but note the or criteria here, or that we have here. Here we have an and, both the requirements. Here any one of the two requirements. Moving on, so we looked at income test, we looked at related test. Let's talk about support test. Now for a qualifying child, the requirement is that the child is not self-sufficient. The child is not taking care of itself. There's somebody else who's taking care of the child. It could of course be the taxpayer taking care of the child or somebody else, but the child is not contributing over 50% to its own support. So child must not contribute over 50%. For a qualifying relative, for the support test, the requirement is the taxpayer contributes over 50%. So basically what we are saying is, in case of a child, it's okay if somebody else is supporting the child as long as the child is not supporting itself. But for a qualifying relative, the taxpayer needs to be supporting that relative, for that relative to be a qualifying relative, for that relative to ultimately become a dependent. Then we have the J of JAR. So we've looked at IRS. J of JAR is the joint return test. But the requirement is the qualifying child or the qualifying relative cannot be filing a joint return. Now, what that means is, let's say for a child, I mean, of course, generally for a child, you'd expect the child not to be married. But there could be children who've grown up, who are full-time students and still fitting into a qualifying child. We'll talk about the A of JAR, which is the age test or the age limit for children. But in any case, the requirement is the qualifying child, and the requirement sort of is the same for the qualifying relative, cannot be filing a joint return unless the joint return is filed solely for the purpose of getting a refund back from Uncle Sam. In case of refundable credits, you could get money back from Uncle Sam. In short, if a joint return is filed, it's okay as long as the tax liability on that joint return is zero. So guys, as you realize, we're talking about all the requirements to check, to ensure whether the child or the relative fits into that jar to be a qualifying child or a qualifying relative. So we've looked at IRSJA. A is the age test. For child, the age test is the child needs to be less than 19 years old. So it's less than up to 19 years for child. This number increases to up to 24 years if the child is a full-time student. Now for relatives, of course there's no age test. You could have your parents as relatives, your uncles and aunts as relatives. So naturally you can't have age test here. But for child, you're looking at kids. So less than 19 years, unless student, so you sort of look at up to 24 years there. The R of JAR is the residency test. Here you're looking at the qualifying child or the qualifying relative being a US citizen or resident of US, Canada or Mexico. Same requirement for qualifying child as well as qualifying relative. So guys, what we are saying is the bunch of requirements here for a child, again, to be a qualifying child, for a relative to be a qualifying relative, and a child has to be a qualifying child before we call the child a dependent. A relative has to be a qualifying relative before that relative is a dependent. Now let's talk about how do dependents benefit taxpayers. And we've already spoken about some benefits, but let's elaborate further. Let's get there. So, number one, we looked at if the taxpayer is not married. Let's say if the taxpayer is single, the dependents could help upgrade status. The dependent could, let's say, help a taxpayer upgrade from a single to a head of household. Also, dependents allow tax credits for the taxpayer. So whether the taxpayer is married or is unmarried, it could be a married filing joint or single or head of household. For the taxpayer who's got dependents on him or her or them, they would be eligible for certain tax credits. So when we did tax credits, when we had the mnemonic, I told you ACE dears equals foreign business winner. The C of ACE is child tax credit and credit for other dependents. So if there's a qualifying child, if there's a qualifying relative, they could be eligible for certain tax credits. So let's talk about a married couple having 2 kids, 2 dependents, 2 child credits out here. Let's say the married couple also have a dependent father living in with them. So the married couple in this case would get 3 credits, 2 for the 2 children and 1 for the father. So tax credits helps the married couple reduce their tax liability. Same thing for a single. A single, number one, could get a status upgrade. Single would also be getting tax credits. Also, when taxpayers have dependents, the expenses that they spend for the dependent could allow deductions. So let's say if the taxpayer is paying for medical expenses of the dependent, that could be an itemized deduction. Let's say if the taxpayer is paying for dependent care or for child care, that could be additional tax credits. So basically, dependents and the support that taxpayers provide to dependents, that could help taxpayers reduce their taxes via deductions and as well as credit. Let's quickly look at a few examples now. Let's say we have a single mother with a child living in with her, where the child meets the IRS JAR requirements and is a qualifying child. So that child would help the single mother upgrade her status from single to head of household. The single mother, when she is filing her 1040, she would file with a head of household status, plus she would get tax credits, child tax credit for a child. Let's take another example. Let's take a guy who's supporting his father, whose father is living with him. The guy is paying for all the upkeep for the father, or the father could even be living in a retirement home, even that's okay. So the father, let's say, meets the requirement of a qualifying relative. Look at the or requirement here. So relative or whole year. So the father is a relative, the father does not have much of income, the taxpayer contributes over 50% and other requirements, all the IRS JAR requirements are met. So the father helps the guy upgrade from a single to, let's say, a head of household. And in head of household, we said for dependent parent, they don't even have to live in. They could stay in a retirement home. That's okay. Now, when the guy is filing his form 1040, instead of filing as single, he would file as a head of household, an upgraded status, get better tax slabs, get a higher standard deduction, as well as he would get a tax credit for his father. Let's now talk about a taxpayer having cousin or friends living in with a taxpayer for the whole year. Now, when you're looking at cousins and friends, let's say the cousin or the friend does not have income. If you look at the qualifying relative requirement, it says relative or whole year. So the cousin or friend could fit in into all the requirements and be a qualifying relative. However, the cousin or friend will not help the taxpayer upgrade to head of household, because this is very clear that it needs to be a dependent relative here, not cousin or friend. So the cousin or friend will not help upgrade status. The taxpayer, let's say, remains single. So when the taxpayer is filing his 1040, he files as a single, but he may get tax credits for that cousin or tax credit for that friend who are dependent on him. Let's do another example. Let's talk about a boyfriend and a girlfriend living in together, where the guy is taking care of all the expenses of the girl. Let's talk about that. So the girlfriend, the question is, could the girlfriend be a qualifying relative? Let's say the girlfriend has no income. The girlfriend is living in with the guy, living in with the boyfriend for the whole year. The boyfriend contributes over 50%. Let's say the boyfriend contributes 100% of the girl's expenses, and all the criterias are met. The question is, can the girlfriend help upgrade the boyfriend's status from single to head of household? And the answer is no, because cousins or friends are not, they could be a qualifying relative, but they would not be dependent relative for upgrading status for head of household. However, so the boyfriend, he's now going to file his form 1040 as a single individual, as a single filing status. However, he could be getting a tax credit because his girlfriend is a qualifying relative. So guys, in short, what we said is dependents could help taxpayers reduce taxes in a variety of ways. Number one, if it's an unmarried single taxpayer, dependents could help upgrade status. For married guys, there's no upgradation of status because married guys only have two options. Married guys have limited options. They could either be a married filing joint or married filing separate. But the unmarried guys could have a status upgrade with dependents. Besides that, dependents could allow for tax credits. The expenses, dependent care, child care, medical expenses, other expenses could allow for deductions and credits once again. So guys, let's get to the book. Look at the IRS JAR requirement for qualifying child or qualifying relative. All of this once again, and then we'll come back and talk about filing status and dependents. On page 16, we're talking about dependents, which could be a qualifying child or a qualifying relative. And the names of the dependents are mentioned on the face of Form 1040. So look at the section and put a box around dependents. So the taxpayer or the married couple needs to write the names of the dependents, the social security number of the dependents, and the relationship. And also evaluate whether the dependents could qualify for, underline, the child tax credit or underline the credit for other dependents. Move to page 17, where we're trying to determine dependency using the IRS JAR test. So fill in the bubbles there. I, that's income test. R, that's related or lives with test. S, which is the support test. J, joint return test. A is for age limits. And R, that's residency test. Now let's do the IRS JAR test first for put a box around qualifying child. Now, for a qualifying child, there's no income test. But the qualifying child needs to be highlight a relative, highlight and lives with the taxpayer for highlight half year. For the support test, the qualifying child must not contribute more than 50% to his own support. Joint return test, the J of IRS JAR, highlight dependent must not be filing a joint return for the year. unless of course the joint return was filed for a refund of all taxes paid or withheld for the taxable year. That means highlight tax is 0. Now, for a qualifying child, we of course have age limits where the child needs to be highlight less than 19 years as of the close of the year. Highlight or less than 24 years if a full-time student for at least 5 months during the year. And on the last column, we have put a box around qualifying relative. For the income test, the qualifying relative needs to have highlight gross income excluding social security benefits of less than highlight $4,150. This is the number for 2018. For the related test, the qualifying relative must be highlight a relative, highlight or should live with the taxpayer for highlight whole year. So cousins or friends could be qualifying relative. Do note that cousins or friends do not help single taxpayers upgrade their status to a head of household. We'll talk about that. Let's move to the S of the IRS JAR test for qualifying relative, where we have highlight taxpayer must contribute over 50% to the qualifying relative support. There's an exception for highlight multiple support agreements, where 50% support to the dependent comes in from 2 or more taxpayers, but only one of the taxpayers who's providing at least 10% of the support can claim the dependency exemption. Next is J or the joint return test for qualifying relative, who must not be filing a joint return for the year unless the joint return was filed solely for a refund of taxes paid or withheld for the taxable year. That means the tax liability was 0. Now, for qualifying relative, they could be adults, so no age limit. But under the residency test, the qualifying relative must be highlight a US citizen or resident of US, Mexico, or Canada. On page 18, we're looking at how dependents can help taxpayers reduce their taxes. Highlight for single taxpayers, dependents may help upgrade status to, put a box around head of household, or even put a box around a qualifying widow or widower. So we've seen how a dependent child or a dependent parent or a dependent relative can help a single individual upgrade to a head of household status. And for a single individual whose spouse has died within the last 2 years and who has a dependent child living in with for the whole year, can upgrade status to a qualifying widow or widower. However, a dependent cousin or a dependent friend or a dependent girlfriend cannot help a single individual upgrade status. So on the row for cousin or friend, highlight no and no. Besides, highlight dependents provide for credits like the child tax credit or credit for other dependents. Write a mnemonic for tax credits out here. Right there. ACE equals foreign business winner, FBW. And circle the C of ACE, because that stands for the child tax credit and credit for other dependents. Also, many of the expenses incurred by the taxpayer for the dependents can be claimed as a deduction or credit. For example, medical expenses for dependents are deductible as an itemized deduction, or dependent and child care credit are available as a tax credit. Now, before we move on, look at the last row of the table out here. Circle cousin or friend and draw an arrow downwards. Let's make notes here. Right? Cousin or friend could also be a girlfriend. Right? Maybe qualifying relative if living in for whole year. And provide tax credits and deductions for the taxpayer. But cannot upgrade single taxpayer's status to a head of household, right? H of H, or a qualifying widower. Let's now talk about methods of tax accounting. And we'll start with the cash basis of accounting, which is used by most individual taxpayers who file 1040, and is also used by most small businesses. And then we'll go on to talk about the accrual basis for tax accounting, which is required for large businesses and of course optional for small businesses. So let's start with the cash basis of accounting for tax purposes. Now, cash basis, that's simple. For a cash basis taxpayer, all the money, all the cash received during the year is income. So income is cash received. For a cash basis taxpayer, expense is all the cash paid out during the year. So money coming in, income; money going out, expense. That's cash basis of accounting. Now, for these cash basis taxpayers, Uncle Sam is a little concerned about expenses. He's worried, he's concerned that it should so happen that these cash basis taxpayers are paying out cash today for expenses they will incur over the next many years. Because if the cash basis taxpayer does that, he gets an expense right now, his taxable income for this year comes down, the tax amount that Uncle Sam would receive would also come down. So Uncle Sam wants to have a check and balance on these expenses of cash basis taxpayers. And that's why he's put in place a couple of exceptions. Let's look at it. Let's look at exception number 1. And this exception says that you need to, as a cash basis taxpayer, you would need to allocate expense. So you will not get an expense right now. You would need to allocate expense over the next many years if the benefits extend beyond the end of the tax year, or benefits extend beyond the end of the next taxable year. Let's look at this. So exception 1 says allocate expense. Instead of getting an expense right now, even if you have paid out the cash, even then you would allocate expense like an accrual basis taxpayer if benefits going significantly beyond the next tax year. So let's look at an example that we have on our book. So it says on December 1st, year 0, a calendar year taxpayer pays a $12,000 property insurance premium. So in year 0, December, towards the end of the year, the taxpayer is paying out $12,000 for insurance premium. for a 1-year term that would begin on Feb 1st, year 1. So think about it. The taxpayer is pretty smart. December, he's paying on December year 0, he's paying out $12,000. He's paying the cash right now. Uncle Sam's worried because the expense, the benefit would start Feb 1st of next year and would go up to Jan 31st of the year after. Uncle Sam says, hey, in this case, you're not going to get an expense. You're not going to be allowed an expense for tax purposes in year 0. So though the cash is being paid out in year 0, in year 0, there is 0 expense. So 20x0, expense amount 0, nothing. Because the expense, the benefits are coming in 20x1 and 20x2. So because the benefits are extending way beyond, Uncle Sam says you will not get an expense. Though you've paid in year 0, you don't get any expense in year 0. So this is an exception. So the insurance term in this case starts on Feb 1st of year 1 and goes on to Jan 31st of year 2. So 11 months here, 1 month here. So we would expense 11,000 here and 1,000 here. So even though the taxpayer is a cash basis taxpayer, he does not get an expense the moment he pays the cash. He allocates the expense the way we would typically see an accrual basis taxpayer do it. However, Uncle Sam is also lenient. He says, okay, cash basis taxpayer, you can expense basis cash paid based on the 12-month rule. So there's a 12-month rule. Now, what this 12-month rule says, let's look at this on the book. So this rule says there are 2 conditions. If number 1, the benefit does not extend beyond 12 months after the first date of receipt of benefit. I know, tax language, not so exciting. Simple thing, basically what we are saying is under the 12-month rule, 2 conditions need to be met. The first condition is that the benefit is up to 12 months. Benefit up to 12 months only. Not like a long-term contract here. And the second one, it says benefit does not extend beyond the end of the taxable year following the taxable year in which the payment is made. Basically, benefit up to next year. So benefit should not be going beyond the next year. Look at this. In this case, in this example, the money was being paid out here, but the benefit was going beyond the next year. That's all okay. But if the benefit was up to the next year, maybe it could have been an expense now. So let's look at the example on the book. So let's look at the second scenario on this example. It says, however, if this policy where the $12,000 is being paid in December year 0, if the policy has a term beginning 15th December year 0, the 12-month rule will apply to the $12,000 payment because the benefit attributable to the payment neither extends beyond more than 12 months beyond December 15th year 0, nor beyond the end of the taxable year following the taxable year in which the payment is made. So let's talk about this. So what we're seeing is, let's look at the same example. So we're looking at 20x0 and then 20x1, x2. Now, what happened in this example was the payment was made in the month of December year 0. The policy started Feb year 1 and went up to Jan year 2. Uncle Sam said that's too long. However, in the new example for the 12-month rule, what we're saying is the payment is made in December year 0. The policy starts 15th December year 0 and the policy ends by December year 1. Uncle Sam says, so much of a stretch, that's a little stretch. 12-month rule is a small stretch. Uncle Sam says, that's fine. Uncle Sam allows the taxpayer the entire $12,000 deduction the entire $12,000 as an expense in year 0 itself. Okay, so this is good news for the taxpayer. Gets an expense, gets a deduction right now. Allocation is you get an expense slowly. So if you really want to save taxes this year, make sure the expenses that you make as a cash basis taxpayer fit into the 12-month rule. Otherwise, you may have to allocate. It'll slow down your expenses, slow down your deductions. You'll have to pay more tax to Uncle Sam. So I told you, we'll talk about 2 exceptions. I've given you 1. Let's talk about the second one. So exception number 2. Uncle Sam's clear that these cash basis taxpayer, if they are paying out interest expense, so they've borrowed money, they're paying out interest expense, and they're prepaying interest expense, that needs to be allocated. It doesn't matter even if it's a 12-month rule. But if it's an interest expense, prepaid, that needs to be allocated for cash basis taxpayers as we typically would do in an accrual basis of accounting. So exception number 2, allocate any prepaid interest. So you don't understand, right? Uncle Sam's agenda here with the cash basis taxpayer having both these exceptions, exception 1, exception 2, so exception 1, exception 2. Typically the agenda here is to slow down the expense. Because Uncle Sam knows if the expenses are too high, his tax for this year would come down. So guys, once again, most individual taxpayers, small businesses use cash basis. But for large businesses, and of course for small businesses and individuals who elect to use accrual basis, so let's cover that on the other side of my board. So we've got cash basis here, and let's talk about accrual basis. And I know you future CPAs, all amazing accountants out here, you guys, you're experts in the accrual basis of accounting. That's all you learn in financial accounting and reporting section of the CPA exams. So right now, for tax purposes, let me just recap it for you. So accrual basis, we know income is when the amount is earned and it's either realized or realizable. So that's the gap rule. Income is when it's earned plus either realized is, you see the cash, the money comes in, or realizable. That means the money is about to come in. Let's say a 60-day credit or a 90-day credit, so on and so forth. Expense under accrual basis, you remember that matching concept. So you expense when it's incurred, basically match to income. So matching concept. So that's the rule under accrual basis. Now for accrual basis taxpayers, Uncle Sam's focus, Uncle Sam's exceptions are focused around the income. Where he wants to make sure that for these accrual basis taxpayer, he's able to maximize income. Uncle Sam's smart. He wants to maximize the accrual basis taxpayer's income. If their top line increases, naturally their bottom line will increase. Taxes to Uncle Sam will go up. So the couple of exceptions that we'll talk about under accrual basis would be focused around income. So let's talk about the first exception here under accrual basis. So exception number 1. So guys, I hope you realize the exceptions that we had under cash basis are focused on the expense part. The exceptions that we have on the accrual basis are around the income part. And the first exception here is that if the accrual basis taxpayer has income received in advance, Uncle Sam wants it to be recognized as income for tax purposes very quickly. He would prefer it to be recognized right now. So exception 1 is for income received in advance. And here the taxpayer has a couple of options. The first option is full inclusion method. So under full income inclusion method, received in advance is income now. Even though it's not earned, it's income received in advance. It's money received in advance. Full inclusion method says the taxpayer has to recognize it as income right now. Or the taxpayer could go in for a deferral method. Under the deferral method, the taxpayer can defer it for a maximum of 1 more year. So basically, in the deferral method, the income would be now plus next year. But it can't go beyond the next year. So next year, I would say at max. Full inclusion method, money's come in advance, recognize income right now for tax purposes, pay the tax to Uncle Sam. Or deferral method, slightly slow, but until next year, make sure it's recognized as income for tax purposes. Make sure you pay taxes to Uncle Sam. Again, as I said, there will be 2 exceptions. So this is exception number 1. Exception number 2 is for rent and interest received in advance. Rent and interest received in advance. In case of rental income in advance or interest income in advance, so cash coming in too soon, even though the taxpayer has not yet earned it, Uncle Sam says recognize income right now. So this one's income now. As you can understand, what Uncle Sam is doing is he is trying to maximize income. The moment he sees these accrual basis taxpayers receiving money in advance, he tells them to recognize income quickly. Under full inclusion method, or if it's rent and interest income received in advance, Uncle Sam says it's income right now. On page 19, we're looking at tax accounting. Put a box around cash method. Most individuals and many small businesses use the cash method of accounting. Highlight allowed for small businesses. Under the cash method, recognize, put a box around income at highlight earlier of actual or constructive receipt. Put a box around expenses are highlight deductible when paid. However, we've got exceptions, right? Exception number 1. Allocate expense. So exception number 1 applies when highlight benefit extends substantially beyond the end of the tax year. Nevertheless, underline this exception does not apply under the put a box around 12-month rule, where the requirement is to write expense immediately. So the 12-month rule applies when underline benefit does not extend beyond 12 months after the date of first receipt of benefit. Circle and underline benefit does not extend beyond the end of the taxable year following the taxable year in which the payment is made. Next we have exception number 2, which is to allocate prepaid interest. So the 12-month rule does not apply to highlight prepaid interest, which highlight must be deducted over the loan period to which it is allocated. Moving down on the page, highlight accounting for inventories. Highlight not required to use accrual method to calculate COGS and inventory. May highlight treat inventories as non-incidental materials and supplies. Turn to page 20. Put a box around accrual method and right there, GAAP method. Under the accrual method, put a box around income is highlight recognized when the all events test is met. That means that all the events have occurred to fix the right to receive the income and the amount can be determined with reasonable accuracy. Now, there's a requirement of highlight book conformity for inclusion of income, which means that the accrual method taxpayer must recognize income no later than the tax year in which the item of income is recognized as revenue for financial reporting purposes. However, there is exception for highlight income received in advance. Now, the income received in advance may be accounted for using either of highlight the full inclusion method, where highlight advance payment received is taxable in the year received, similar to a cash basis taxpayer, right? Or and highlight deferral method, and a few lines below where highlight advance payment received can be deferred for a maximum of 1 year beyond the year of receipt. There's another exception whereby highlight rent and interest received in advance are taxable in the year received, similar to a cash basis taxpayer. Next, put a box around expenses. So in general, deductions are claimed in accordance with the same matching principle used for GAAP.